Now we're going to turn a bit more to rates. And before we get into that, we just wanted to highlight an adjustment. So overnight, there was commentary that the Democrats have come up with a way to get $3.5 trillion moved through the system and achieve all of the goals that Biden laid out. So if you remember, the infrastructure plan was meant to be a little, about $1 trillion, let's just round it. And now they're trying to figure out if they can get the $3.5 trillion, but they would need every single Democrat to vote in the Senate. And that is going to become a question of what happens, because Manchin has been someone who has been a bit more hesitant to spend that kind of money. We know that Bernie Sanders wanted $6 trillion because why do zeros matter? Let's just call it $35 trillion, give every individual in the U.S. $105,000 and call it a day. I mean, it's just becoming absurd. But again, these are things that we have to look at. It's not official. It was broken last night. We want to wait to see if we get some of the backdrops of where that money's going to be spent, over what time frame, how is it going to be paid for. So again, those are things that we're going to look at. But we did want to look at corporate equities and mutual fund shares by wealth percentile group. So if you, I laugh at it, not because it's funny, because it's not. It's just the wealth divide, and then the fact that the Fed doesn't know why, I just think is just amusing at this point, because you have to be willfully ignorant to not know, or to claim to not know. So when we look at the top 1%, you can see that they have now control about 53.5% of the wealth. When we look at equities and mutual funds, the 90 to 99% is 35.2%. And then the 50 to 90% are 10.8%, with the bottom 50% of America at 0.6. So, I mean, if you're not sure on why there's a wealth divide, well, who owns equities and where have equity prices gone? Who doesn't own equities and who hasn't benefited in the rally? I mean, to me, it doesn't seem that hard. Maybe I'm oversimplifying it, but again, something that I like to see in general. So then the share of total net worth held by the top 1%, 99th to 100th wealth percentile, is over 32%. So 32.1% of total net worth held by the 1%. So look at 1990 and look at 2001 and look at where things kind of went haywire. And if you look at that recession of 2008 to 2010, and then what happened in that period, I believe that there was QE, and then QE went up, and then it started to slow, and then you can see it started to slow, and then you started to see that wealth drift away a bit, and it's back. And it's back in aggressive means, and here is the backdrop. So now let's look at the individual who's like, I don't want to miss out, and let's look at the retail flow into U.S. equities and ETFs as we go through the end of the year. And this is through the from year end to today, and you can still see that there is a large amount of individuals moving into the U.S. Equities, trying to capture some of this dream that we've seen of new capacity. But while all of this is happening, we're seeing a fall in housing affordability. And there's different ways to break apart this number. So we're going to do it in 3 different ways. So the housing affordability gauge surpasses 2008 levels, where the unaffordable homes. And this is just looking at a gauge is OECD average of house price to income and house price to rent indices. So this is looking across the OECD and where the affordability is, and you can see it is deteriorating. Now, this is not just the U.S. This is Canada, New Zealand, Australia, and going into Europe, and you can see just how elevated it is and how we have taken out what I thought was absurd numbers in 2006, but never say never in a market that is being backed by central banks. So then when we look at the median existing home price divided by median household income, we're right at those levels in 2005, 2006 of 5.18. We're right at 5.10. So we're getting to that point. And it's really because, as we've said, and we've shown this chart so many times, home prices going parabolic and wages going sideways. So again, wages just haven't gone up and kept pace with inflation as home prices explode to the upside. But then when we look at that housing affordability index, it looks at it a little bit differently, because this is just looking at how affordable is the home based on the interest rate. So when you think about the interest rate, because again, as long as you have the down payment, interest rates are 3%, 3.5%. So as long as you can put down 20%, it's really not terribly unaffordable to buy something as long as you have the upfront cash. And that's kind of the difference of looking at it in different ways. And that's why we wanted to be fair and look at it in multiple ways. But again, the one that continues to stick out is across all OECDs, and why we continue to see some of this pressure when we're looking at the underlying market in general. So then when we look at borrowing, so how many people are borrowing against gains? So securities-based and other non-mortgage loans to wealth management clients at Morgan Stanley, just using this one specific, is almost at $70 billion. So far in 2021, $70 billion or so have been given as a loan against securities. And this is when we start talking about margin calls, because this is, again, as the value, or if, because Lord knows that doesn't happen, if the value of your portfolio drops, you have to make up some of this backdrop. So again, these are some of the risks that remain within the system, or landmines that are not as often talked about. So, but when we look at infrastructure returns, and this is selfish because, again, private equity fund, looking at infrastructure, especially private infrastructure, you can see how things continue to outpace infrastructure returns versus the MSCI world. This is when we talk about, what is happening in general, looking across dams, looking across electrical capacity, pipelines. All of this is, again, leading to why we think it is a very interesting opportunity to get invested. But now let's talk about rates. So let's think about what rates are. And the Taylor rule is just essentially looking at where rates should be based on a slew of inputs. So, but the Fed funds effective rate is at 0.05%. So we're at 5 basis points. The Taylor rule is telling us that we should be at about 5.29%. And you can see that it broke earlier. Like, look at 2012 through 2018. It was well ahead, and we didn't see Fed funds effective rate really adjust till 16. But what happened in 16? The triple R. And that's why we talk about it so much, because that is an indicator of how much liquidity is in the market, which is why you have such, look at the Taylor rule estimate, and how, even though the rate of change is elevated, it's still not straight up. The reason why it's getting like this is because of the liquidity side, because of that the triple R, which is why we talk about it so much, because it's a huge indicator of just how inefficient the market is right now, given the liquidity, given the bond buying, given the rates, and where rates really should be based on some of these estimates. So then the spread between the two is at the highest level it's been at since 1975. So 1975, it was at let's call it 6.5%, and right now we're at 5.2%. Just to give you an idea of the differences that we're seeing and the pressure that remains in the market. So then when we look at this, what is some of the drivers? Well, let's go back to 2001, June 30th, 2001, and go forward. Let's look at U.S. personal income. Where has income gone? Where has CPI gone in terms of how that green level? S&P 500 has gone parabolic from this 2000, essentially 2020 and beyond. NASDAQ, look at where the NASDAQ is, with barely even a blip in terms of what COVID was to where it is today. But look at home prices. Again, all of these are pulling up, leading with the U.S. of what the Fed owns. So look at what the Fed owns. Obviously, it went up, but when did it go parabolic, and what has everything done in response to it? And that's when we start looking at, well, let's look at the break-even numbers, because we had obviously a fairly ugly inflation number and a sloppy 30-year auction. We had, it traded through the tail of 1.96 and 1.976%. Instead, it printed at 2%. The bid to cover was at one standard deviation lower than previous. So, and this is on the 30 year. So we're starting to see those issues, which is why we've been talking about we're not really coming back down. Instead, this is going to continue to drive higher as we look at what the break even is. And at some point, that break even number, that this white line here, the 10-year break even inflation rate, is going to pull up this generic government 10-year pricing. When we look at where this is and the delta between the two, so if we look at where it was in terms of where it was over 2% back in 2019, you had that big drop in the summer. This is where the trend is going to pivot and turn back up, again, leading to some of those increasing rates. So the Fed ownership of Treasury markets, this is just looking at what do they own, and the reason why we keep talking about this is because QE was above Treasury issuance. So this is where they continue to buy more, which is why people were saying that supply-demand technicals in the bond market was the biggest reason why we had that move lower in rates. So now that has adjusted, we're going to get a truer view of where Q3 can shake out, as we progress forward. When you look at U.S. Treasury notes and bond issuance, they continue to go up on that 4-month change. And given our receivables have gone up as well, but we still have a deficit, we still have a roll, and we still have more treasuries being issued, with the likelihood of hitting our debt ceiling in October 31st of this year. So this is the pivot. This is what we've been talking about. The more Fed Treasury purchases exceed net issuance, now we're back up. Now we're at a point where net issuance of treasuries is going to push back up, again, sending us higher in general. So then what does that mean? Well, where are rates right now? So rates have been low. So what does that mean? Number of auto loans and leases originated from January through March were back above 2015 highs. And you can see where we sit with just on the amount of loans, auto loans and leases, credit cards. Everybody is looking to give credit card loans. I have good credit score, a good credit rating, and I get constantly letters and emails and everything else wanting me to take credit card loans. And this is why, because it's a credit card loan. Even if you have good credit, it's still going to be at 10%. And why wouldn't they want to get 10% from someone if they can borrow it at under 1%? And again, these are some of the reasons why we keep seeing this move into the system. And we have a lot of forbearance. So Federal Direct's student loan portfolio, if just based on what has been said coming into the election, everybody stopped paying. Everyone said, well, why am I going to be in repayment? I'm going to delay until you guys figure out what you're going to do with my student loans. So this could become a big overhang if they don't come up with a way to alleviate this, because people haven't been paying their student loans for over a year now, 18 months. So this is an overhang that is one of those little ones that I don't think the market appreciates as remaining as an overhang in the system. So then when we look at extra unemployment benefits driving wage growth, we haven't seen too much in terms of where it is, because this is looking at states ending benefits, not ending benefits. We're still unsure on what the final shakeout's going to be of if you're allowed to leave early or not. But you're seeing, again, some of the pressure in general as wages do on the average hourly earnings continue to drift higher. But real wage versus productivity. So productivity has gone up even though wages have stayed stagnant, because there's more help. There's more automation. There's more algorithms. There's more things to help you do your job. So I don't have to pay you as much because I'm replacing some of your decision making, and that's driving more productivity without having to pay additional. And this is where we've seen some of this backdrop and shakeout where wages just haven't kept pace. A lot of those investments, instead of going in terms of bonuses or additional wages to the individual, have gone to technology to make things more efficient. But loans and leases and bank credit, all commercial. So this is looking at what deposits. So we're starting to get to the bottom of where this rate is. And this is looking at, if I give a bank $1, they're going to invest, at the top here, they're going to invest 77 cents. Here, it's telling me that they're going to invest 62 cents. So you can see that huge drop on investment. But when you look at the RRR, it just exploded again. So this is, again, going to be kind of a manipulated number, but it just shows you that banks are struggling to lend. A mixture of two things. They have too many deposits and not enough opportunities to lend, hence back to the credit cards and auto loans. And this is looking at commercial and industrial loans where there's just less being made because CapEx has been cut. As CapEx has been cut, this has kept things essentially a little under pressure where just people aren't coming in to try to get those loans and trying to save some cash, which again is leaving more in the bank, increasing that RRR. And then this credit, the Federal Reserve consumer credit. The May increase in consumer credit was the highest on record as Americans tapped their credit cards, auto debt as well. So again, this is the net impact of what we've seen. And remember, what we showed earlier was only through March. So it's actually going to go higher again based on what we've seen in general. And when we look at what the net number is, consumer credit is still below with the trend. And not to say it needs to stay on that trend level, because that trend level is not sustainable, but just gives you an idea that we're back above pre-COVID levels and we're still moving along this elevated component. And it shows you just where we are, because that showed percent change. This shows net trillions. So we're just below 4.3 trillion, even though we had an increase of 35%. So again, just that elevated level going forward. All of this, so talk about Fed, talk about all this. All of it is resulting in junk bond yields minus consumer price index is actually negative. So we are at a point now where junk bonds do not cover inflation. So at the end of the junk bond, you will actually have lost money when you factor in inflation and the value of $1. Welcome to the new paradigm. So but what does that mean? That means that people who have junk bonds or high yield bonds will issue them. And here we are. We have a huge surge so far in 2021, as we did in 2020, of high yield issuance. New issuance yields for high yield bonds. And so this is where you're seeing the average rate. The average rate has hit a new all-time low, even though there's even more paper. Now, CLOs obviously don't want to miss the party. So U.S. new issue CLO sales may hit a record this year, according to B of A, based on where we are currently and what the projections are going forward. So again, low rates, a lot of inflation, a lot of problems in terms of the just underlying supply chain and just plumbing of the rates world, which is creating this weird bifurcation that will resolve itself in a certain direction, and we think it's going to resolve itself in higher rates in general. So now that we went through the U.S., we're going to go deeper into Europe and emerging markets, and what do we see happening in that region.